3 weeks into the Iran war, oil prices are up by more than half. Global stocks are falling. But the true risk is that this is only the beginning. I've got 18 years of experience as an investor and former pension fund CEO, and I actually started my career in oil and gas finance on Wall Street. And even though the news has been talking about the Strait of Hormuz and high oil prices for weeks, I can tell you that most Europeans don't understand the full extent of what is happening and what that could mean for investors. Now, before I get into the details, let me be clear. I'm not saying you should panic or sell stocks. In fact, I just invested a 5-figure sum into the market, and in a minute I'll explain why. But the risks are real, and every stock investor needs to understand them. So everything starts with the price of oil, and there are actually 3 layers to how this terrible war is affecting oil prices. The first layer is the obvious one that everybody's talking about, the Strait of Hormuz closing. This is that narrow stretch of water on Iran's southern border, which controls passage between the Persian Gulf and the rest of the world. 20% of the world's oil passes through this strait normally, so now that the Iran war has largely shut it down, that has caused the biggest disruption to global oil supply in history. And even though the US military is much stronger than Iran's, and even though Iran's missile capacity has been largely destroyed, Iran's navy is in shambles, well, it turns out that it's pretty easy for Iran to keep the strait closed. All it takes is a few drones or rockets to create a real threat to shipping. Plus, there are reports that Iran has started mining the strait, which is a massive threat to any ship passing through. And when you have threats like this, insurance companies refuse to insure oil tankers. And then ship owners refuse to take the risk of moving ships through the strait, and traffic stops. So that's the first layer, and it's bad enough because even if the conflict were to stop today, assuming that there are mines in the water, it could take weeks or months to fully reopen the strait. But that is actually only the tip of the iceberg. To explain the second layer, let me ask you a question. Every day, Persian Gulf countries pump huge amounts of crude oil out of the ground, around 1/4 of the world's total production. Normally, most of it gets shipped out through the Strait of Hormuz. But if the strait is closed, where does the rest go? Well, part of it still gets shipped out through pipelines, but capacity there is very limited. So the rest of it has to go into storage. But the problem is there's only so much storage available. In fact, reports indicate that the Persian Gulf is largely out of storage tanks for oil. And when there is no more storage, you have to stop pumping. Plus, of course, Iran's drone attacks on oil infrastructure aren't helping either. So, as a result, Gulf oil production has dropped from 30 to 20 million barrels a day, and it's likely to keep dropping. And that brings us to the third layer. Most people probably never think about it, but oil wells are not like your bathroom sink where you can open or close the faucet whenever you like. As soon as you shut in an oil well, as soon as you shut down production, that sets off a ticking time bomb. Depending on the well type and the equipment involved, geological changes start happening inside the well, and the equipment risks becoming damaged. The longer the well stays shut, the harder and more expensive it becomes to restart production. In fact, in some cases, the well can become completely unusable, trapping the oil underground. So, because of these 3 interlocking layers, even if the Iran conflict ends today, that doesn't magically fix the problem. In recent weeks, the global oil price has been yo-yoing up and down along with Donald Trump making announcements about the war. But even Trump doesn't have the power to simply fix the problem and restore the flow of oil. No matter what happens, we are going to see a supply crunch that lasts several months at a minimum. Unlike market movements, which are hard to predict, at this point this is quite predictable because it's due to the laws of nature and engineering, not human psychology. So the question is, what does this mean for the economy and the financial markets? Well, the first, most direct effect is going to be inflation. When people hear about crude oil prices, they think about gasoline. They think it's going to be more expensive to fill up the car. And that's true, but it's only a small part of the big picture. When you go to your local grocery store or shopping mall, pretty much everything you see on the shelves was carried there on a truck that runs on diesel. And to make diesel, well, you need crude oil. So that means pretty much all the products you have in the economy are likely to get more expensive as crude oil gets more expensive. Oil is also an essential ingredient for many products, including plastics. So the inflation shock that is coming is pretty much unavoidable. Now, the good news is today the world is much less dependent on Middle East oil than it was in the 1970s, when spiking oil prices caused years of high inflation, which reached as much as 13% per year in America at one point, and that led to heavy economic stagnation. Now, today, the US is a much bigger producer of oil, so America is not so dependent on the Middle East. And also, renewable sources provide a lot more of the world's energy, so the impact should not be quite as dramatic. But inflation is still going to happen. And then the question is, what will this inflation mean for financial markets? Now, before I answer that, here's a thought. The next few months are likely to be intense for European investors. If you're not a professional investor, it might be difficult to keep up with the news and figure out what you pay attention to and what you can safely ignore. So if you'd like a bit of help with that, I actually write a newsletter for European investors. It's got over 100,000 readers all over Europe, and in the newsletter, I cover market updates, but also insights for ETF and index investors. So if that's interesting, simply follow the link in the description to sign up. So what's the effect of high inflation on the financial markets? Well, the most direct relationship is to the bond market, because when investors see high inflation coming, they expect central banks to push up interest rates. Okay, one of the main jobs of a central bank is to control inflation. And the way they do this is by pushing up interest rates, by making borrowing more expensive for regular people and for businesses, which pulls back on demand and which has this dampening effect on prices. So when you have these inflation shocks, bond prices tend to drop and bond yields tend to shoot up. And that is exactly what we saw as the Iran war broke out. If you look at a chart of the US 10-year Treasury yield or the German government bond 10-year yield, you see a sharp increase when this conflict started. Now, will this increase continue? And how long it will keep going, that is dependent on many factors, such as what happens with the price of oil and how long this disruption lasts, and also how the economy responds. Because sometimes when you push up interest rates, that can push the economy into a recession, and then central banks again start lowering interest rates to stimulate the economy. So it's useful to understand these things so you're not surprised when you look at your portfolio and you see bond prices dropping or rising, but I would not recommend trying to time the market and buying and selling bond ETFs based on predictions of what's going to happen, because the timing is very, very hard to predict. So that's bonds. But most of you are probably more interested on the effect on the stock market. That's where most of us have most of our financial investments, right? And the thing is, stocks are even harder to predict than bonds. Unlike what many people think, the stock market is not a direct reflection of the economy. Just because there's trouble in the economy doesn't always mean that the stock market drops a lot or that it stays down for the full duration of the trouble. Stock investors largely value stocks based not on what's happening today, but on future expectations. So if there's an expectation of huge economic trouble that lasts for many years, then yes, you could have a stock crash, which lasts for a long time. But if the expectation is that maybe in 6 months or 12 months, this whole thing will blow over, then the impact can be relatively minimal. Let's look at history and see how oil price shocks have affected the stock market in the past. The most dramatic example was the 1973 oil shock, when OPEC, the Organization of Petroleum Exporting Countries, announced an embargo against countries that supported Israel during the Yom Kippur War. As a result, oil prices shot up literally 4 times, and then they kept going up over the coming years. In 1974, there was a massive crash in global stock markets. And while this crash recovered within some months, over the following years, the market basically stagnated. It went nowhere. The 1970s became a lost decade for stock investors. After adjusting for inflation, stock investors lost money. But we also have to be aware that there were other economic problems in the 1970s, and oil shocks don't always lead to this kind of dramatic outcome. For example, another oil shock happened in 1979 with the Iranian Revolution. This led to oil prices doubling, but despite this big oil price shock, the stock market just shrugged it off. The early 80s were actually a really, really strong time for the stock market after the lost decade of the 70s. Then in August 1990, Iraq invaded Kuwait and oil prices more than doubled. There was a price spike that lasted for 9 months. This actually caused a recession in America. But American stocks only went down for a few months. Then they recovered, and the following years, well, they were not amazing, but they were positive for stocks. And of course, the most recent example was 2022, when oil prices spiked during COVID, along with other inflation drivers as global logistical chains got totally disrupted by the pandemic. The immediate effect on stocks was quite dramatic. Stocks went down around 20%. It was a big crash. But the following years became incredibly powerful for the market. The S&P 500 went up 24% in 2023 and 23% in 2024. So aside from the 1970s, that one really bad example, in many cases, when we have had these oil price shocks, there has been an initial pullback in stocks, which recovered more or less quickly, and then the market went on to perform just fine. So if that is a common pattern, you might say, well, why not just sell now, wait for the market to drop, and then buy at a much cheaper price? Well, that is always tempting. You could try it and you might get it right. But this is a form of market timing, and it's really, really hard. First of all, the past is not the future, and we don't know which scenario it's going to be. Second, it's very hard to guess when a market drop is going to happen. And third, which is usually the biggest problem, it's very hard to guess when the drop is over and when it's time to buy again. So what usually happens is that if you are a market timer, somebody who plays this kind of game, you can get it right once or twice or thrice over your investment career, but you are going to get it wrong many more times. And on average, you will be much worse off than if you simply kept investing every month without worrying about what the market is doing at the moment. So here's the mindset that I adapt. If stocks crash, I will be fine. Yes, I will lose some money in the short to intermediate term, but it's also going to be a great opportunity to buy companies at lower prices. So I will take advantage of that. If stocks stay strong, well, that's fine. I'm still invested. There's no problem. It's basically a win-win approach, but it only works with one condition: if you can stay calm and invested when the market drops. It is very, very important to have the psychological preparation. Okay, so you need to be ready for big disruptions, which absolutely can happen given what's going on in the world right now. And you also need to be financially ready to weather them. This is something I tell my students basically every week. I'm probably going to keep saying this every week for the rest of my career, but you've got to cover the basics. Make sure that you have a safety cushion sitting in the bank so that if your income goes away or you have some unexpected expenses, you don't have to sell your ETFs. You can pull some money from the bank and cover the needs that you have. Make sure that you're taking an appropriate level of risk for your age and your risk tolerance, and make sure that your portfolio is diversified. But as long as the basics are covered and you have a good mindset, I don't think you have that much to fear from these geopolitical disruptions. That said, it's always easier to stay calm as an investor if you're not doing it alone. So that's why I encourage you to sign up for my newsletter for European investors. Simply follow the first link in the description.